ran into a great example this week of why the lowest interest rate is not always the best deal. I was working with a client. We were actually doing a transfer for them, moving them from one lender to another at their maturity. But this actually would apply even for a new purchaser as well, a new mortgagor, someone getting a new mortgage as well. And so they're out in the country a little bit. So I actually had called the BDM at the bank I was going to submit it to ahead of time, just to make sure it was a location they could work with, and they said yes. And so I submitted the mortgage to them, or the application to them, and it was declined. I called up the BDM and I said, hey, the deal we were talking about was declined. Do you know what happened? Was it something about the location? Anyway, he agreed to look into it, and he actually had it escalated. In the meantime, while that was happening, I submitted it to another lender as well. So it turns out the next day, the application was approved by both lenders. Now, the second lender I submitted it to had a lower interest rate. It was actually 0.4% lower, almost 0.5% lower. So on the surface, you might think that's the better deal, but it actually wasn't. And here's why in this case. It came down to prepayment privileges. This client had a lump sum of money that they wanted to apply to their mortgage. They'd already exceeded their prepayments with their current lender, so into the new mortgage, they wanted to make a prepayment as soon as possible. With this second lender, you can't make prepayments until the anniversary date, so basically 1 year in. So basically, I ran the numbers. I checked the math. A lower interest rate, but not making the prepayment till a year in, versus a higher interest rate, but being able to make that prepayment up front. And I ran the math a bunch of different ways over the 1 year, over the 3 years, and indeed, the higher interest rate, but better prepayment options gave them the better deal. At the end of the 3 years, they have more paid off their balance, they've paid more principal, less interest, and they have a smaller balance outstanding. If it had gone long, if it had been a 4 or 5 year deal, it might have made more sense with a smaller interest rate. But in this case, where it's a 3 year deal, it did not. Another thing that turned us away from that second lender as well is they didn't really have a good refinancing option. If you ever wanted to refinance the mortgage, you couldn't with that lender without having an actual sale. They had a sales clause in there. You can't, if you were going to break the mortgage, it has to be because you're selling the home. So 2 strikes for them. So the client understands it's a higher interest rate, but because of the prepayments, they're going to actually pay less interest and more off their principal, and they're happy. And so this comes invaluable actually for anyone who potentially gets lump sums of money through whatever their job is, sometimes contractors or different salespeople who want to be able to make prepayments and pay their mortgage down faster. It's important to have a mortgage that lets you have the options to do it as often as you want, or at least more often than once a year.